Hey everyone, I want to talk about the three most dangerous words in financial planning: target date funds. First of all, your age has nothing to do with your financial plan. Not every 40-year-old or every 50-year-old has the same financial goals or is in the same financial place. So that's the number one reason why I do not like target date funds. Number two, they give you a false sense of security that you're in the right investments for you. I recently looked at some of the different glide paths that these target date funds have, and I'm just going to use Vanguard as a proxy. If I'm 40 years old, I would be allocating 35% of my money to international stocks and 13% to bonds. As a 40-year-old who does not need portfolio income, I do not want to own bonds. Bonds have historically earned about 3% more than the rate of inflation over time, while stocks have earned about 7% more than inflation over time. Why kick field goals when the goal is scoring touchdowns? Fast forward 10 years until retirement, I still have 26% allocated to international stocks, but now I have 35% allocated to bonds. So in a typical scenario here, you're talking about a 50-year-old who's allocating 35% of their money towards bonds. At this point, a 50-year-old is traditionally entering their peak earning years. So this is when they are supercharging retirement contributions. If I am trying to invest and score touchdowns for the life of my financial plan, I do not want a higher and higher allocation going to bonds. I want to think about fixed income or having bonds really when I'm in that retirement red zone of being in about 5 years before retirement. That is when hedging against the sequence of return risk becomes really important. So I think the real question is, why do we want to own bonds? We view owning bonds as a place to go when the market zigs, we have something that zags. And our preference is we do not want to own an open-end mutual fund owning bonds. We like having a laddered approach where we know that we have bonds coming due and we know that we have kind of a yield to worst as long as there's no defaults. So we do not like the structure of an open-ended mutual fund, especially in a rising interest rate environment. A quick bond lesson: when interest rates go up, the value of the underlying bonds go down. We want to have the ability through laddering to hold that bond to maturity. If the stock market is down, we don't want to be in a place where we have to sell into weakness. So there we would use our bonds, we would sell bonds to raise cash to fund our monthly income. So in our view, we think bonds are appropriate once we enter that retirement red zone, which is about 5 years prior to retirement. While we're in the accumulation phase, our personal philosophy is that we want to be a long-term, goals-driven equity investor because we want to score as many touchdowns as possible. We believe that the industry's definition of safe assets versus risky assets is completely backwards. The reason that we invest is to outpace inflation. We want to increase our purchasing power over time. The greatest probability that we have to do that is invest that in growth assets. What are the asset classes that can create a rate of return greater than inflation over long periods of time, meaningful periods of time, which we would begin to define as at least 10 years. So for our long-term bucket of money, we want to have as much of that in equities as possible. Even when we retire at 60 or 65 years old, we need to have the lion's share of our funds in equities, especially if we're healthy. If we're going to be living a 3-decade plus retirement, we need to have as much growth on that money as possible because we know that the effect of inflation is grinding, and a $10 burrito today turns into a $25 burrito in 30 years just through 3% compounded inflation. This doesn't mean that you cannot invest in a target date fund, but you need to actively know how those dollars are allocated and see if it matches up with your plan. As always, have a plan, review it often, make changes when necessary, and invest confidently.